What's up, you guys? Welcome to the Options Income Strategies channel here. One of my goals for this channel is to share the various options income strategies that I'm currently working on and that I implement on a weekly or monthly basis. And my goal for this channel is for me to be able to share this with everyone, to be able to document my journey and be able to meet like-minded people along the way and be able to build a community around it. To share the basics of my investing strategy, I'm actually a long-term investor, but I also use a portion of my portfolio for an income strategy where I get income from options and then I use most of those profits to invest in stocks which are at fair value or undervalued. Before we proceed further, I want to make sure that everyone knows that this is not financial advice. You should do your own research. This is purely for educational or entertainment purposes only. Now, if you're a complete beginner and you're not familiar with call or put options, first and foremost, I recommend that you go and get yourself familiarized with it. There's a really good channel called In the Money where there's a 1 hour course or a video where he talks about how to trade options for beginners on Robinhood. He does an excellent job of going through the basics, making sure you understand every single thing that goes through with options and what calls are, what put options are, and the different strategies. Okay, and now once you get a full understanding of it, come back to this channel so you can follow along with the different strategies that I'm implementing on stocks or indexes every week or every month. Okay. No, just as a refresher though, if you do know your basics, a call option basically gives you the right to buy 100 shares of a stock at a particular strike price by a certain expiration date. But put options, on the other hand, gives you the right to sell 100 shares of a stock at the strike price before the expiration date. Okay, so when you buy a call option, you're betting that the stock price will go up, but if you buy a put option, you're betting that the stock price will go down. Now, normally, call and put options involve a lot of risk because if the stock doesn't go in the direction that you want it to go, then you will tend to lose all your money. Whether it's a call option where you can lose all the money that you put in, or whether it's a put option where the stock price goes to zero or the company goes bankrupt, you lose way more than you put in. Okay, so because of that, buying what are called naked calls and naked puts, you put yourself at a lot of risk, which is why I almost never buy naked calls and naked puts. The only strategy that I implement are called credit spreads. Okay, now I'll explain what credit spreads are. So to understand how credit spreads work, let me open up this website called optionsprofitcalculator.com. Okay. So here you have optionsprofitcalculator.com. So at first you have all the long call, long puts, or the naked call, naked puts that I was telling you about. But what we're going to look at is our spreads. Okay. So let's look at a call spread. Okay, so with call spreads, what you're essentially doing is, depending on whether you buy a call at a higher price and sell a call at a lower price or vice versa, is completely determines what your strategy is. For example, as you can read here, if you think the stock price is going to go up, you buy a call at a lower strike price and then you sell a call at a higher strike price. This essentially means that you're betting that the stock price is going to go up, but in case it doesn't go up, then you're limiting your losses and getting out of the strategy. Okay, or vice versa, if you buy a call at a higher strike price and you sell a call at a lower strike price, then you're betting that that particular stock is not going to go higher than a particular break even. Okay, so for example, let's take the S&P 500 index. So I'm betting, so say 1 month down the line, I'm betting that the stock price probably won't go about $294. And I want to bet that as long as the price stays below $294 in the next 1 month, I'm going to make a profit. This is how you do it. Go to select an option, say June 1st. Okay? You choose a much higher call that you want to buy. So let's say 297. Oh, before I do that. So these are the calls and these are the puts. These are the different the bid and ask price and the mid price. You may not always be able to buy the mid price, but if you, for in this case for our study, let's assume you can get the bid price, and this is the strike price where you're going to buy your call options. So let's choose 297 to buy, and then I want to sell. Now, remember what I said? I said like I'm expecting that the price will stay below $294. So that means I have to sell a call that's below 297. So let's say I chose the 292 strike that I'm planning to sell. Now all I need to do is hit calculate. So what this essentially shows you is the maximum return you can get is $208 as long as the price stays below $294. Okay, and the maximum risk you see is if the price goes to 297 or above. Okay, so as you can see, anywhere below 294, let's look at June 1st on the day of expiration. Anywhere below $294, you're going to make a 71.2% profit, which is equivalent to $208. Okay, so that's the strategy that we're going to use. Now, let's take another example. Let's select VOO, which is the Vanguard S&P 500 Index Fund. Now let's say I want to bet that VOO is going to stay below $280. So let's take about a month out, June 19th. I buy the 285 call, and then I sell the 280 call. Okay, calculate again. Here we go. So now we're saying as long as the price stays below $281, I'm going to make a profit of $140, which is a 38.9% profit. Okay, and the maximum risk is $360 if the price goes to 285 or above. Okay, now what I want to show you that's going to be really helpful is since you've given yourself a month, if you go farther ahead and notice that the price is starting to go up too fast and you're going to get really close to the break-even price, what you can do is you can actually sell this call and buy this call and then increase the credit spread. For example, say the price is approaching 278, 280, and you think you still have a week or two left before June 19th when this is going to expire. What you can do is you can sell this 285 call, buy back the 280 call that you sold, and then go ahead and buy a 295 call and sell a 290 call. And now you get a credit of $57 from it, but now your break even is $290. So in the next 2 weeks, as long as this price doesn't go up from 278 to 290, you'll keep the initial credit that you made, as well as make another 12.9% profit, which in this case is $57. Okay? Now what you need to remember is, every time you do this in whatever brokers that you use, in my case, I'm going to use Robinhood. Let me show you that really quick. So let me go to SPY. There we go. So even though your maximum risk might only be $400 or $500, what Robinhood actually does is it always takes in a certain amount of cash collateral. Okay, so here, as I mentioned before, I bought the 297 call. I bought 5 of those calls, and I sold a 292 call, 5 of them, and I got a credit of $1,015. Okay, so this gets directly deposited into your account, but till it expires, Robinhood or your brokerage holds the $2,500 as collateral. Okay, now as long as the price is only 282, and as we saw before, the break-even price is 294. Now in the next month, as long as the price stays below 294, I'm going to continue holding this option strategy. If it does start breaking through that, I can always push back that call credit spread, where now I buy the 297 call and sell, or rather I buy the 292 call, sell the 297 call, and then spread it out to say a 302 call, and then I sell the 297 call. That way the break-even price could be $299. Okay, So this is a great strategy that you can use to where irrespective of which way the price is going to go. Now, as long as if the price keeps going down, you'll make a profit. It doesn't matter how far down it goes. Okay, you're only at risk when it's going up high. So that's what I wanted to share for now for this first video. I'll provide updates accordingly. If you have any questions or comments, please feel free to leave them below. Okay, thanks for watching. Please leave a like and subscribe if you want to follow along. Okay, thank you and take care.